Hello, welcome. My name is Oscar from the Finance Society at Stockholm Business School. Today we're going to look at money management in swing trading. What is a swing trade, you might ask? A swing trade is when you hold a stock or a position for a couple of days, 3 days, up to, let's say, 3 weeks. So it's a kind of short-term trade compared with a buy and hold strategy, which would be buying till it's worth because it offers great dividend, and keeping it for 15 years. I'm not going to talk about that because that's not my strong suit, and you can find good help with how you should manage your portfolio for the long term from other sources. So let's look at swing trading. In this example, we have 10,000, or I should say $100,000, because that's what we have. Each position is going to be 10% of these 100,000. So 10% of 100, that's 10. So each position is going to be $10,000 big. Each loss, our maximum loss that we can tolerate, according to our rules, is 10%. And that is 10% of the position. So that is $1,000. So in each trade, we're willing to lose $1,000, and that is 1% of our whole trading capital. And our standard profit in this case is going to be 10% as well. Sometimes you may just only find 5%. Sometimes you may get it break even. Sometimes you might get 200%. Who knows? But in this example, we just calculating that we get a standard gain of 10%. That's again $1,000. So I just made a quick Excel table here. Your capital, your entry price, and your close, and your profit loss, and your position size. As you see, when I make a profit, I have more capital. That means our position size is gonna go up because we allow a bigger position, because it's still 10% of my capital. So let's just put in a couple of dummy numbers here. 10.9, 8.12, that's a good gain. 9.10 and 10.9. Now let's say we time the market quite badly, and we'll get 6 losses in a row. This is 6 losses in a row. So we started off the year, we're up 4.5%, which is pretty good. Then let's say something happened and the market just crashes a bit, so we lose six trades in a row. We are protected from this big drop in the market. Maybe the market dropped 20%, we don't know, but we're protected and only losing 6% of our trading portfolio, because we have 10% positions, and we're only allowing us to lose 10% of the position on each trade. Let's say 9/11 would happen again, God forbid. This is nothing you can predict, because we can't fortune tell. And if 9/11 would happen again, the market could easily set 20% in a couple of weeks. And we need to protect ourselves from these scenarios. Of course, maybe the market goes skyrocketing and we only have smaller positions, but hey, it's a gain. The money management is here to help you not go bankrupt. Because let's say this 9/11 2.0 would happen, but we allow a bigger loss. Let's say we allow a 30% loss and 20% positions. That means we allow this. So in the beginning, our position size is 22,000 because we take bigger positions and we're willing to risk more money. But what you see is we start off taking $20,000 positions, and by the sixth trade loss in a row, we only take $800 position instead. So it's a very quick succession that we lose our money. There's something not quite clear here. As you see, if we allow a 20% freeze position and 30% loss freeze position, that means that we're going to risk more money. We're allowing bigger losses than the 1% of each trade. So now we're accepting $6,000 per trade to lose, and that's 6% of our trading capital. And that might not be a great idea. So instead of losing only 6%, as we would in the previous example, we are losing now from 10% up to 80%. So we will lose 30% on these 6 trades instead of 6%. Of course, if we just flip the numbers, 712, 710, 710, 710, 710, 710, well, we would make awesome gains. But this would be great if we could calculate this, if we could predict this in a almost certain way, which we can't, because as likely as we predicted that this catastrophic thing would happen, it might just happen the other way around and we would lose a lot of money. So the money management is here to help us to control our position size, so we can trade another day, another year, and just keep trading and keep investing. Let's just change these to some dummy numbers again. 25, 23, 12, 10. Can't allow 10 because it's more than 10%. 9, 80, 88, 120, 125. Let's say with these 10%, I would say that you can trade good companies or stable companies like JP Morgan and ExxonMobil that are liquid on the market, in the market, so that you can get rid of them in a split second if you don't like it anymore. But let's say you find a small cap that you really enjoy. For example, I traded a Chinese brewery a couple of years ago. They were doing, I think, whiskey out of corn in China. And Chinese breweries are not a safe investment. And it ended up fine, but who knows what really happens in a Chinese brewery. You can't really trust the numbers they produce, because they might just be false. So in this case, we can't take a 10% trade. That would be insane, putting 10% of your trading capital in a Chinese brewery. So I would put just 1%, because my guess is they could easily just go under. So all I put in the stock, I don't put 10,000, I put 1,000. So I bought it at 35, and then I sold it at 350. So that's a great trade. But just again, flip the numbers. I risk 1% of my portfolio. I buy it at 35. I sell at nothing because they go bust. I only lose 1,000. And 1,000 here is, again, 1% of my trading capital. And maybe you can see this as a lottery ticket, but it's a calculated loss. This loss, or this position, I held for 6 to 9 months. I can't really remember, and it worked out. But that I'm willing to take that risk on that company, but I'm not willing to take a larger risk on that company than I would with JP Morgan. JP Morgan is a more stable company and not going to give me hundreds of % return. So I take a smaller position to protect myself. Because let's say I take 10%, my normal position, and they go bust. Then I lose 10 grand, and I'm comfortable at losing 1% of my portfolio at a time. After I lose 1%, I can analyze what did I go wrong here, how can I improve, and hopefully before I reaches nothing, I know I'm a better trader and I have evolved and make more clever decisions. But if I just take 2 large trades, let's say again I buy at 80 and I sell at 20, my money is surely, I'm losing money, I'm bleeding money everywhere, and I can't tolerate that. So I need this money management to control my position size, so that if something happens that I can't predict, I don't go bust. I have my rules that I'm not going to lose much more money. Might not gain the same amount, but again, you can have 10 positions simultaneously, some long, some short, and if you have done your analysis correct, then it should be enough for you to be comfortable. But you don't want to take too large of a risk in case something happens that you can't predict, because then you don't have any money left and you have to start over from zero, and that's not very fun, is it? I hope this haven't been too confusing. If there's something you don't understand, just put it in the comment section and I'll try and get back to you as soon as I can. And I think this, especially for swing trading, this is a foolproof way of getting the correct position size for you to stay afloat if shit would hit the fan, to be very clear. As always, have a good week. Talk to you next weekend. Bye.